Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll take a look at the telecommunications company Comcast and how it's benefiting from its theme parks.
Plus, we'll look at how oil and gas companies are investing in low-carbon technologies.
But first, we begin with some news in tech and energy.
This week, Constellation Energy agreed to sell power from a Clinton nuclear plant in Illinois to the tech giant Meta Platforms. It's a 20-year contract starting in mid-2027.
And this comes as nuclear power has emerged as one of the biggest winners from the AI-fueled surge in electricity demand.
For more on the tech side, we are joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. And we first asked Mandeep why Meta needs this deal with Constellation.
If they're raising their capex, which they did in their last earnings, that capex is going towards, getting more AI chips. And, if you are putting more AI chips, you need more power. So clearly, that is where the shortage is right now. And look, if this is an AI super cycle that we all believe it is going to be the case, and I think you will see a power super cycle as well. And in this case, all the hyperscalers will be looking to procure power for their data centers. I mean, Meta serves over 3 billion monthly active users across their family of apps. Now, granted, those users right now are using more CPU compute, but if you're rolling out AI tools and LLM searches, you need more power for the AI chips, and I think that's the intent here.
Hey, Mandeep, let's be honest here. I mean, all you tech guys, you Silicon Valley guys, you always think you're the smartest guys in the room. But let's be honest, you guys don't know anything about the oil and gas business and the nuclear business. Why is Meta, and I'm guessing some others, are going to kind of get more deeply and strategically involved in the energy side of their business? Is this a trend here?
Just look at how far they have come in terms of, infrastructure. Like a company like Google, not only are they designing their own data centers and, creating their own chips, and now they are, procuring power to the extent that they want to make sure that these AI chips, which can have volatile power needs, are most optimized when it comes to the efficiency of their infrastructure. And that's why these hyperscaler companies really have got so many different aspects to their moat. So it's not just about the search algorithm, or in the case of Meta, their social media knowledge graph. It is about the entirety of how they run their infrastructure. And that is what is a long-term moat, because nobody else can operate at the scale at which these hyperscalers are operating right now.
This is a fun fact in the article by Will Braid from Bloomberg. So Meta, first of all, has a global energy head.
They have a global energy head.
Yeah.
Okay, all right.
So they do. They're really kind of ramping that out. And
Okay.
they were looking at proposals. They announced in December they were looking at proposals for as much as 4 gigawatts of new U.S. reactors, and it received 50 proposals from a range of companies, including Constellation, to that point. I'm also wondering, Mandeep, the significance of when they're building data centers and hyperscalers for LLMs, a large language model, and that training, versus when they have to build stuff for inference, which could be smaller and more co-located, so closer to the cities, closer to where Paul and I have our phone. Does that tend to look different then in terms of their power needs?
Absolutely. And I think so far the market was concentrated towards training. Every year you would have a 10 times larger model, which was more intelligent, and it could do more in terms of, answering your queries. But with inferencing, you're right. I mean, the traffic patterns may vary depending on the population. And so if you're serving traffic in New York, it's very different from serving traffic somewhere else that may not have the same concentration. And with that, I think the challenge these companies have had is the transmission lines can't be upgraded. I mean, you need, a pretty lengthy review process, and the whole thing may take years. So right now, they are trying to procure power wherever they can to offset the increased consumption, and some of it may come at the expense of power usage for some other purpose than why data center is being prioritized here. And that is what will be interesting, because with inferencing, the power needs can be variable. I mean, one trend we have seen is with reasoning, you need more compute. So, the model is thinking a lot more at the time you are putting the prompt in, as opposed to training, where all of the training is happening in background over a period of few weeks. So reasoning is per query, and depending on how complex your query is, the model is doing more work, and that's why it may need more power.
Another data point from this new Bloomberg News article: Meta is contracting for more power after the company's total electricity consumption nearly tripled from 2019 to 2023. So, yeah, I guess they need some more energy. Mandeep, is this in the CapEx numbers for Meta and for these other tech companies, or do they need to take those CapEx numbers up even more if they're going to get deeper into the energy space?
I mean, all signs are the CapEx numbers may continue to go up, but right now the biggest component of the CapEx is still the spend on the GPU chips. Obviously, the power needs will take some portion of the CapEx, but it's still not as big as the chips. And think of it this way: if you're getting, 20,000 NVIDIA chips, the cost of keeping them idle or not being able to utilize them 100% is way higher than anything you are spending in terms of, the energy deal that they had. So clearly, they are focusing on utilizing the chips that they have already procured, and that's why they are proactive with, these power deals.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We recently focused on a Bloomberg Big Take story entitled "A Fatal Tesla Crash Shows the Limits of Full Self-Driving." You can find it on Bloomberg.com and the terminal.
The story looks at how federal regulators are investigating whether Tesla's Robotaxi system is dangerous, even with a human behind the wheel.
For more, we are joined by Craig Trudell, Bloomberg Global Autos editor. We first asked Craig to walk us through the details of what the issues are with completely autonomous vehicles.
I guess maybe the thing to start with is the Teslas that you can buy today that are on the road now are not that, right? They are not autonomous. You can pay extra for a system called full self-driving, and yet it's a misnomer. It's a system that you have to pay attention to at all times. If you get into a crash, it is on you, and we've seen that play out. When Tesla customers have tried to come after the company says, look, we warned you, we told you that you're responsible for driving while using this system. The company is trying to make this leap. It's been trying to make this leap for years to eventually get to a point where you do not have to supervise, and even to take it further than that, take the human out from behind the wheel altogether. And we hear Musk, talk about that quite a bit lately, because it's something that they're actually trying to commercialize, even just in the next matter of, next week or so. There's a lot of questions about how exactly they intend to do that, whether they can do it, especially after he's predicted, year after year that they're on the cusp of doing it. And part of the reason there are doubts is because of the hardware, and I think that's kind of an important aspect of today's story is this particular crash involves, an incident where a driver was using full self-driving, driving into the sun, and that appeared to play a part in the crash, which resulted in a fatality, and it led to a federal investigation that is ongoing.
I mean, this is all very much feels as part of the growing pains as we kind of understand this technology and how it works itself out. So what are the steps that Tesla is taking and that the regulators are taking at this time?
Yeah, so we should acknowledge that this incident happened in November 2023. Tesla has changed. They've made upgrades both to hardware and software. Hardware for certain customers, I should say. But in terms of their approach to the sensor system for their vehicles, Elon Musk has been, really sort of out on a limb and having this view that all you need is cameras. And companies that are also in this space, I think the one people recognize the most is Waymo, the Google company, and they use a mix of camera, radar, and LiDAR, and their sensor set is much more expensive. It's more extensive. These sensors are placed all over the vehicle. But the sort of bet here on the part of Waymo is that is worth it. It will mean this system is safer. What Musk has tried to do is go with the cheaper route, go with the system that he can afford to put in every Tesla, and make this bet that he can develop his way to autonomy faster by sort of leveraging the broader Tesla fleet, even if it means putting cars on the road that draw scrutiny from federal regulators as to whether or not this is unreasonably unsafe.
So, Craig, I think Elon Musk is back at the company. What does that mean? I mean, are you hearing anything like, okay, now we can get back on track, now we can really move forward, maybe at a higher velocity? What's that mean?
Yeah, I think it's difficult to tell at this point because he's kind of coming back to business means coming back to so many businesses, right? And so on a day-to-day, we're seeing him travel to his various companies, devoting some time and attention to them. But it's not as though he's sort of 100%, focusing in on Tesla and neglecting all of his other businesses. We see him, regularly engaging with, users on X about, troubleshooting problems that they have with that service. I would say he is, more actively engaging there on Tesla Matters, and definitely is trying to sort of send this signal that, okay, it's time to get back to business here. But whether or not that's, resulting in sort of tangible changes at the company, I think remains to be seen.
What's the rush for autonomous driving?
I think 40,000 people die on U.S. roads every year, right? And so the rush, of course, is to bend that, to change that. And I think one of the challenges that you have if you're a company in this space is we've now, seen a lot of companies pursue this for, roughly a decade. That number has not budged. So, we still have a long way to go to where this capability is, putting a dent in those figures.
Our thanks to Craig Trudell, Bloomberg Global Autos editor. Coming up, a conversation with the CEO of TAE Technologies on the company's approach to commercial fusion power.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to the telecommunications space.
The cable provider Comcast recently opened its newest theme park in Florida called Universal Epic Universe. The goal is to keep guests staying longer and spending more in the competitive Orlando market.
And according to research from Bloomberg Intelligence, Comcast theme parks are poised to become one of its most valuable assets, with revenue and EBITDA set to jump by around 40% from 2024 to 2026.
For more on what this means, guest host John Tucker and I were joined by Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst. We first asked Geetha to talk about Universal's new park.
May 22nd was the grand opening of Epic Universe in Florida. This is the first big park that has opened in Florida in 25 years, and it was the biggest investment by Comcast in a theme park. They spent over $7 billion on just this park. So as you said, huge investments by Comcast in their theme park business. This is really an area of growth for them, especially now that their broadband business is struggling actually quite a bit.
So what is this likely to do for their earnings?
So, you kind of think about Comcast and you think about Disney. For Comcast, let me start with Disney. So for Disney, parks is actually 60% of their profits. For Comcast, it's really maybe less than 6%. So again, for Comcast, 80% of their money, of their profit still comes from the cable business. But really, as we kind of think about what their strategy is here, and you look at all of their portfolio of media assets, I mean, we're really excited about the theme park business because growth is great, returns on investment are great, and this is really a fantastic way for Comcast, just like what Disney has done, with kind of deepening all of those relationships with those universal characters. You think of all the IP that they have with Minions, with Jurassic Park, now with Wicked, and some of the other franchises that they have with Harry Potter. This is just such a great way to build on that fan engagement.
How much can the theme park business, how much do you think that could be worth for Comcast? Because again, you mentioned that some of their core businesses like the video business, the traditional cable business, even the broadband business, they're facing some headwinds here. Theme parks are going to become more and more important for investors, I think, going forward. So what do you think the valuation could be?
Absolutely, Paul. So that's a really, really important point that you bring up. So you think of the cable business, which is really their mainstay. Cable valuations have actually dropped pretty significantly over the past few years. We've gone from about 10x to around 6.5 to 7 times EBITDA multiple. You think about the park business, though, it's actually quite the opposite. Most of the some of the pure play park operators are trading at about 12 to 14 times EBITDA. So again, this is an area of growth. Experiential businesses are seeing this huge upswing. And so we think that just based on about $5 billion in EBITDA, which we think Comcast can get to in a few years' time, that business could be easily worth, $45-50 billion or upwards of that.
So my takeaway is they're a Disney wannabe at this point. I gotta wonder if they're going to start poaching Disney executives too.
That's very possible. I mean, right now they're still a pretty small player, John, when you compare them to Disney. So you just kind of think about Disney in terms of theme park visitations. We are looking at about 150 million global visitors to Disney parks every year. Wow. Compare that to Universal or Comcast's parks, it's about 60 million. So still much smaller than Disney. But what they're doing now is a lot of expansion. So we had this new park, Epic Universe, which opened just last week. They're actually opening a new park in London in a few years' time. They're expanding with new properties in Las Vegas, in Texas. So basically, when you put all of that together, we're thinking that they are basically going to expand visitation from about 60 million by 50% to about 80 to 90 million. So they're really kind of closing in on that gap with Disney.
Stepping back, the Comcast stock story, I mean, how do people view it here? Because again, cable TV business just in secular decline. The broadband business, which had saved it for a good decade or so, that seems to be stalling because of competition. And the cable networks, I don't know what they're doing with them. What do investors think about Comcast?
Yeah, it's really a tough story right now, Paul. As you rightly point out, I mean, broadband is, again, majority of this business is really tied to how broadband does. So, any stock movements are directly correlated to the health of the broadband business, which actually is in a very, very tough spot right now. So this is a business that was gaining about 1 to 2 million subscribers every year. They are still one of the largest broadband providers at about 30 million subscribers in the US, but they are going to lose close to about 1 million subscribers this year as, the telecoms kind of really intensify competition. So it's really a tough story right now. The one thing that we are kind of looking out in terms of a positive catalyst is the spin-off of the cable networks. So this is something that they announced last year. It probably happens a little bit later this year. They're calling it Versant. What's going to be interesting is not just the spin, but what happens after the spin. So will Comcast really look to become kind of this consolidator of media assets? And that would, I think, be a little bit of an interesting story in media. But unless they can really revive growth in their broadband business, I think it's going to be a little bit of a tough sell.
What's Disney's response to Universal to Comcast?
So Disney, a huge response in terms of what they have planned over the next few years, John. So they are really kind of doubling down on their parks business. Again, this is really the bread and butter for Disney. 60% of their profit comes from the parks business. So they have about a $60 billion investment planned for parks over the next, 7 to 8 years. And it's not just the theme park experience. It's, they're having parks on water, what they call parks on water, which are the cruises. And that's a huge investment for them. We think that business basically doubles, triples revenue as they keep on adding these new cruise ships to their fleet. So they are doubling down on parks as well.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We move next to the energy space.
This week, we looked at a company called TAE Technologies. TAE develops commercial fusion power with the cleanest environmental profile.
The company also recently raised more than $150 million in its latest funding round, exceeding the company's initial target for the round.
For more on what the company's doing, host Paul, John Tucker, and I were joined by Michl Binderbauer, CEO of TAE Technologies. We began the conversation by asking Michl to break down exactly what fusion power is.
So it's basically what nature does best, right? It gives us our life and energy here on the planet from the sun. So any star you look up is a fusion reactor, basically, right? So what we're trying to do is to replicate that terrestrially to make essentially copious power, carbon-free, clean, and sustainable for the future of humanity.
Where are you in the process at TAE?
So we're very close. We're just one machine away to get to a point where we actually harvest more energy than what we're putting into the facility. This has been obviously a long journey. It's hard to do terrestrially. The stars have a lot of gravity. We don't have that. We have to use other means, magnets and all sorts of things. And as you've probably seen over the last few years, there's been a plethora of news inching really, really close to the goal line across multiple efforts on the planet. So we're about a 3-year away to get to net energy, and somewhere early 2030s, we hopefully have a power plant online.
What would be, if you were able to achieve it and have a power plant, like, what is that? Is that just tremendous amount of energy with like no footprint?
Yeah, it's very small footprint. So it's the highest energy density fuel you can have, about factor of 5 to 10 higher than fission even. It utilizes hydrogen or light species that are ubiquitous. So there's infinite fuel supply, if you will. And you would harvest clean energy out of that at probably starting at a scale of a gas-fired turbine. So something like 400 or 500 megawatts per plant. And it would literally be able to distribute wherever you needed it in the grid.
Can you talk about the economics surrounding this technology? Who would be the users, the buyers, the developers of this technology?
Yeah, so I think what we're seeing, and this gets to what we just announced, raising capital, we really have a long partnership with Google.
Okay.
And they've been deep with us on machine learning and tools to help make this more efficient and more economic. And in fact, they would be a great first off-taker for that, right? All the hyperscalers, everybody that has high energy intense applications growing at tremendous rates, right? With a gap between supply and demand developing, is looking for electrons, and particularly green electrons. So those would be probably the first off-takers for this technology.
Oh, I got to ask.
What
sets you
apart? This is John Tucker. He likes his fusion.
What sets you apart from ETAR in terms of the reactor itself, the containment? That's a tokamak fusion reactor or what?
Yeah, so good question. So ITER and others are working on tokamaks. We actually are not. We're working what you see, if you have a visual. We have a compact machine about the size of a gas turbine that can make about the same output as those other plants. It's much more efficient, uses smaller magnets. There's various tricks in the physics that allow you to do that. And that brings something that's more compact, cheaper to produce, of course, more economic to deploy, easier to maintain, et cetera. And you can essentially centralize these. We think we can build those sort of cookie cutter in the factory and deploy on site. And the other thing I should add is that siting on this compared to the other nuclear cousin, which is fission, right, is a lot easier. There's no meltdown possibility. There's no sort of nuclear accident of substance that people would have to worry about. It's truly clean and benign. And so you can deploy it where you need it in a much more straightforward way.
And there's no use of beryllium in that reactor?
No. In fact, ours is using hydrogen and boron, both of which are light and super ubiquitous.
Well, deuterium as the fuel, right?
So deuterium and tritium is one fuel cycle. That's used by some of us in the fusion community, and we can burn that too, but we're really focused on hydrogen and boron ultimately. That turns out that only makes helium. So you have no neutrons, you have no radioactivity to speak of. It is just a nirvana of energy, essentially. You get ubiquitous fuel in, no radioactivity or pollution in the process, totally sustainable. And we think it will be competitive from a cost perspective. It'll be probably starting out mid-field in current generation asset costs. So you're not as cheap as gas or renewables, but you're not as expensive as fission is today, is somewhere in the midfield, and then trending down.
Okay, let's pretend that neither of us understood what any of you guys were talking about in terms of beryllium. That's why we have him, right? He knows a lot about a lot of different things. Before we let you go, just how hard is it to have gotten to where you are? Like, what has been like the biggest hurdle?
Oh gosh, it's been an enormous journey. I mean, I've aged. I started this out of graduate school with my brilliant PhD mentor, and then it took us about 20 plus years to amalgamate the technology around it. There's a lot of esoteric, absolutely extreme things you got to master: power supplies, accelerator technology, diagnostics, feedback loops. Use a lot of machine learning and AI, a lot of that we developed together with Google in the last decade. That can react on the blink of an eye to make changes in what happens inside, and do that reliably and consistently. And so those are all the technologies we now have. So now we're putting in the last machine. So it's been a long journey and developing lots of technology to do that.
Our thanks to Michl Binderbauer, CEO of TAE Technologies.
Coming up on the program, we're going to look at oil and gas companies and how they're investing in low-carbon technologies.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors.
This week, we looked at oil and gas companies and how they're investing in low-carbon technologies.
For more, we were joined by David Doherty, BNEF Head of Natural Resources Research.
We first asked David what U.S. oil companies are thinking with regards to investing in fossil fuels and more green-friendly technologies.
Yeah, economically friendly is a great choice of word versus environmentally friendly. Two separate things sometimes. And the story is very different if you're looking at a US major versus a European major. Even the technology they'll invest in general, the group of big oil companies we talk about, investing about 7-8% in low carbon technologies, things like wind, solar, carbon capture, renewable fuels. 7%. Yeah, and it's plateaued around there for the last 2-3 years. Yeah.
But it's something. I mean, put it that way. But what we learned is that the Trump administration is taking back some of the loans and the money that a lot of these oil companies are using for some of those projects. Exxon in particular, they have a project in Texas that's going to use hydrogen, and that funding is gone.
Yeah, Baytown, right?
So now what happens?
Now what happens? I mean, a tax break would be great for somebody like an Exxon. They could probably go ahead without it. Arguably, the pro-oil Trump administration isn't necessarily ticking the boxes for the oil companies at the moment. We're seeing these tax breaks, we're seeing really low prices, not necessarily all down to policy, it's worth highlighting, but not beautiful if you're a US oil company, for example, or with exposure to US production, particularly onshore shale, for example. It's not a great time for them. It's not the worst time, but it's not a great time.
Are the European energy companies, or just outside of the US energy companies, are they stepping up and trying to fill that void for some more environmental friendly technologies?
Not really. No, not really.
Because they got so punished for that. Just look at Shell and BP.
Yep.
They made some decisions maybe I'm not sure they would make again. That said, some of the biggest players are still the European ones. Equinor, for example, last year, wind, solar made a comeback. That's really interesting. They've got really poor cash flow stories, much lower returns than the traditionals. So you're definitely seeing a split between the US and the European majors, for sure. But the environment's completely changing for all of them.
So I hear your point, particularly in the U.S. Like, then Exxon, they can probably still push ahead in Texas, even without the loan. They might not like it, but they can manage it. But a lot of these companies can't.
Right.
So what happens to the projects that are already underway that deal with, carbon capture, direct air capture, decarbonization?
They go looking for more money, or they stop?
Is the money there, ex-government?
I think so. There's jitters for sure, right? This is a 4-year window, and is it a 4-year window, or is it an 8-year window? Nobody knows. Nobody's going to bet on that or guess. But for the right, anything will happen for the right price, I guess, is the bottom line. But it's a huge question mark for U.S. in the next 4 years for sure.
But if we have oil down here in the low 60s for an extended period of time, what are the oil companies? I mean, do they have capital to invest back into fossil fuels, or do they just give it back to shareholders?
It's a mix. If you look at the players that don't have, let's say, a family presence, right? You know, your mom knows, I know, Chevron, Exxon. Yeah. If you think of an EOG or any of those companies that don't have necessarily a household name, they've got a very different way of operating. At around $60, you're getting into territory where it's going to start to hurt a lot of the US shale players. 55 is where you'll see Bakken start to fall out of profitability. That will go down. You're about $12 below that for a break even for something in the Permian. So there's still space to play. But you know, the guidance we're seeing for CapEx quarter on quarter is down about 3-4%, whereas production's down marginally, like 1%. So the impact of the actual production will happen a lot later than the CapEx story. But they're starting to, you know, tighten their belt a bit when it comes to spend, and we'll see that in barrel terms later, like more delayed. But you will see it come through. You're not seeing it yet.
I also have to wonder too what winds up happening with, say, offshore projects. So onshore is much more reactive, but say Gulf of Mexico, a lot of production is going to come online. That investment decision was made years ago, so you can do nothing about it. But then if you're making decisions today with this oil price, looking at the curve for 2027, 2028, that's when you get some question marks.
100%, yeah, and that plus like all this extra barrels coming out from OPEC, new projects in Guyana, for example, coming online and ramping up. Short term looks like pain. Longer term, this investment's still needed. Otherwise, you get into territory of price spikes or inflationary causing short supply. So it's a really delicate balance for them at the moment.
So if I were to go to the oil patch down there in Texas, would they be happy today or not so much?
No.
It's been worse, and I think we have a habit of saying crazy times, crazy times. It's not really that crazy at the moment. $60, if you think about it, we had 55 flat for about, what, 2 years, just 2-3 years ago, and Texas was booming. When you're in Houston, it's flying, right? So we're not in the territory of fear just yet. I know it makes for a great headline, but data-wise, we're still a bit away from the pain. And US shale always surprises to the upside when it comes to efficiencies and when it comes to how resilient it is, right?
So, and then to your point, the production's only down fractionally, whereas CapEx is down more, speaks to that point. But I feel like the difference this time is that oil companies went into this administration super pumped. I mean, super pumped is actually an understatement.
And pumped is a great choice of words.
Yeah, exactly. But then the reality's been so much different. It feels like that's the differentiation versus the underlying oil price. And totally a little confusion. I mean, what was $1 billion the oil industry gave to, or the energy industry gave to President Trump? And then they're like, wait, what?
What did you do?
So it feels like that's a little bit different there. Is there one form of low carbon investment that's just toast?
Ooh, green hydrogen, CCS look hard to justify without some form of a tax break, and the knock-on impact for that's pretty significant if you think of it in things of like e-fuels or synthetic fuels. All of that is needed to make those things down the line. So those two, kind of toast. The other ones, wind, solar, they're kind of standing their ground a bit more.
Our thanks to David Doherty, BNEF Head of Natural Resources Research.
We move next to some news from the financial sector.
This week, Wells Fargo CEO Charlie Scharf cleared the Federal Reserve's 7-year-old cap on assets, allowing the bank to grow and compete with larger rivals.
For more on this, we are joined by Hannah Levitt, Bloomberg Senior Finance Reporter.
We first asked Hannah how Wells Fargo is now positioned for its next stage of growth.
Yeah, so this has truly been such a long saga for them. Like, I started covering Wells Fargo more than 7 years ago. They had just gotten put under this cap at the time. I was still enjoying my mid-20s, and, you know, now we are no longer there. For Charlie Scharf, this means that he can finally play offense. He can, you know, they're not capped in size to their level at the end of 2017 anymore. And remember, that's been a huge deal for them along the way. I mean, some of the businesses that he's marked for growth, like the trading business most notably, that's been constrained because it's more balance sheet heavy, and they haven't been able to allocate that balance sheet because they're restricted. And like, just for context, JP Morgan, the biggest US bank, has grown almost an entire Wells Fargo in terms of assets in the time that Wells has been capped.
Wow. All right, Hannah, full disclosure, I have my checking account with Wells Fargo, but I'm guessing the CEO and the management team there, they want to do something more than that. They think they can do a little bit bigger and better than Paul Sweeney's checking account. So what are some of the businesses, you mentioned trading, are there other areas where they think they can really grow by allocating more capital there?
Yeah, absolutely. So the businesses that Charlie Scharf marked for growth, in this time while he was running the firm, but it was still under the cap, were investment banking and trading and wealth management and credit card. But virtually every business aside from mortgage, which they've said they're shrinking. And remember, Wells Fargo used to be huge in mortgage at one point. They were churning out 1 in every 3 home loans in the country. Every business other than that should grow now, and they have room to do that. But I think those businesses where they've already said that they're targeting growth, that may be where the earliest moves are. We've reported that they're working on a high-end credit card, so that could be something that people see. But yeah, so it really it goes across all of those and beyond now because they don't have this constraint anymore.
So how quickly can they scale in the other parts of their business?
Yeah, well, it's an interesting question, right? Because we've seen, the tales of banks trying to grow too fast and then having, a calamitous blow up. And so that's something that they definitely want to avoid. And Charlie Scharf has talked about that it's not like an on switch day one, but it does give them more flexibility so they can, the most immediate thing is the trading business where they just have capacity. But besides that, it's more being able to lean into more enthusiastically those growth initiatives that they've already kind of outlined.
Right. So, Hannah, they now have the regulatory capability to maybe do more, to maybe grow a little bit more quickly. Do they have the balance sheet to do that? Do they have the capital to do that?
Yeah, they have a ton of excess capital. And that's been a theme throughout. I mean, even in the earliest days of the asset cap, like they couldn't deploy that capital, so they gave investors a bigger dividend and more buybacks than they were expecting. It was sort of like you wouldn't think that would be the outcome, but it was at the time. So they've had excess capital, and also because the banks in general were preparing for the possibility of tougher capital rules that have not panned out. So a lot of them have been hoarding capital anyway, sitting on a bunch of extra.
What we're seeing in Wall Street is definitely a competition for talent, particularly if you wrap in hedge funds as well as huge asset managers or private equity. Can Wells Fargo play in that game?
Yeah, they already have been. I mean, they hired Fernando Rivas, who is the head of the corporate investment bank there. He was a major hire from JP Morgan, so that was huge for them. And, they've made other hires over the years. Doug Braunstein is there, another former JPM executive, and he's vice chair. They have Barry Summers running wealth. So they have, they've been able to get talent at the highest level and then, even further down as well.
Our thanks to Hannah Levitt, Bloomberg Senior Finance Reporter.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.